So, you're running your own business. Maybe you're a consultant, a freelancer, a single member LLC. You've got some good income. Your CPA told you to open a SEP IRA or a SIMPLE IRA. You did it. You're contributing something. You feel like you're doing the right thing. Here's the problem. For most solo business owners, the SEP and the SIMPLE are the wrong plan. And switching to the right one, an individual 401k, is completely free and takes about a week. I'm Matt Losanno with Cinder Wealth. In this video, we're going to walk you through the 3 most common retirement plans for single owner businesses, and why most CPAs default to the wrong one, and what you can do about it before the end of the year. Quick disclaimer. This video is educational only. It's not personalized tax or financial advice. Plan selection depends on your specific income, business structure, and goals. Always consult your CPA and financial advisor. Let's define these clearly so we're all on the same page. The SIMPLE IRA. SIMPLE stands for Savings Incentive Match Plan for Employees. It was designed for small businesses with employees. It's not ideal for solo owners. And here's why. The employee contribution limit in 2026 is around $18,100, and the catch-up contribution for those of you over 50 is lower too. That's it on the employee side. Your employer match options are limited too. For someone making $150,000 or more, that's a really low ceiling. There's also a 2-year rule. Money you put into a SIMPLE can't be rolled into a traditional IRA for 2 years without penalties. That creates a lock-in problem most people don't even know about when they open it. The SEP IRA. SEP stands for Simplified Employee Pension. This is the one CPAs love because it's genuinely simple to set up. You contribute up to 25% of net self-employment income, capped at $72,000 in 2026. For high earners, a SEP can actually be pretty good. But here's the catch. All the contributions come from the employer side only. There's no employee contribution, there's no Roth option, and there's no loan provision. The individual 401k, also called a solo K, uni K, etc. This is the one most solo business owners should have. It combines an employee contribution up to $24,500 in 2026, plus an employer contribution of up to 25% of net compensation. Combined, you can get up to $72,000 or more, depending on your income. If you're 50 or older, you can add another $8,000 in catch-up contributions. And there's a new catch-up too for those 60 to 63. It also has a Roth option. It allows participant loans. It costs nothing to set up at most major custodians, and there's no annual filing fee requirement until your account balance hits $250,000. So why doesn't every solo business owner have one? Because CPAs default to what they know. The SEP is simple to explain and simple to report. The solo 401k takes a little more setup, and most CPAs are focused on compliance, filing your taxes correctly, not on designing the optimal plan for your situation. Let me show you why this matters with some real numbers. And I want to be clear, these are examples, not guarantees. Your actual numbers depend on your specific income and how your business is structured. So let's say you're a consultant, single member LLC. You're making $150,000 in net self-employment income. With a SIMPLE IRA, your employee contribution cap is $18,100. Your employer match is limited. Let's say the total contributions land around $22,000. With a SEP IRA at 25%, of net compensation, you're looking at roughly $37,500. Now, with an individual 401k, you can contribute $24,500 as an employee. That's the full employee limit, plus up to 25% of net compensation as the employer contribution. Combined, you could potentially reach $62,000 at that income level. Same income, same business, but with the solo 401k, you could potentially defer almost $25,000 more per year than with a SIMPLE. At a 20% combined tax rate, that's $5,000 in actual savings annually. Do that for 5 years, you're talking about some real savings. Every dollar you don't defer is a dollar you're handing to the IRS today instead of letting it grow for you. And once the year is over, that opportunity and the growth that comes with it, it's gone too. 2 more things that individual 401k has that SEPs and SIMPLEs don't, and they matter. The Roth option. A Roth 401k lets you make after-tax contributions that grow tax-free. If you expect tax rates to go up, or if you're in a lower tax bracket now and expect to be in a higher one later, Roth contributions can be incredibly valuable. SEP IRAs have no Roth option. SIMPLEs have no Roth option. The individual 401k does. The next one, the loan provision. With most individual 401k plans, you can borrow against your own balance, up to 50% of the vested balance or $50,000, whichever is less. Now, I'm not saying you should borrow from your retirement account, but having the option matters. Business owners sometimes need liquidity, and being able to access retirement funds without a penalty or taxes, just a loan you pay back to yourself, can be a useful tool in certain situations. Look, the individual 401k isn't perfect for every single situation. If you have employees other than a spouse, you can't use it. If your income is very high, a SEP might actually get you to a similar contribution number. And the solo 401k does require an annual form, 5500 easy filing, once your balance hits $250,000. But for the target audience of this video, solo operators, consultants, freelancers, spouses running a business together, it's almost always the superior option. Now, here's the urgency. To contribute to an individual 401k for 2026, you have to establish the plan by December 31st, 2026. That's the hard deadline for new plans. The actual contributions for the employer side can be made up until your tax filing deadline, including extensions, in 2027, but the plan has to exist before the end of the year. This isn't a complicated process. Most major custodians like Fidelity and Charles Schwab offer prototype solo 401k plans that take a few days to open. So, if you're sitting in a Simple or a SEP right now, and you're not sure if it's the right plan, that conversation with your CPA should happen soon, not in January. And if your CPA says, just keep the SEP, it's fine. That might be true for your situation, but it's worth asking. Did they run the comparison? Did they look at what an individual 401k would actually let you contribute at that income level? Or did they just recommend what they always recommend? That's the difference between a CPA focused on compliance and an advisor focused on planning. Here's what I want you to take away from this. If you're a solo business owner, consultant, freelancer, single member LLC, or running the business with your spouse, and you're not in an individual 401k, it's worth a conversation with your CPA. The contribution limits are higher, the flexibility is better, the cost to set it up is zero at most custodians, and the deadline is December 31st. This is the first rung of the tax deferral ladder for business owners. Once you have it in place, there are more rungs above it: cash balance plans, advanced entity strategies, and full coordination across your tax and legal picture. And we'll cover those in the next video. Subscribe for more content on tax strategies and retirement planning for business owners. This video is for educational purposes only, not personalized tax or financial advice. Plan options depend on your specific situation. Always consult your CPA and financial advisor. Thanks for watching.